Good morning to all the participants. So, just a quick disclaimer before starting the webinar that the stock ideas and the themes that we'll be discussing today. So, it's just for the educational purpose and do your own research before investing in those ideas. So, starting with the webinar, today we are going to discuss about the market outlook for 2024. But uh, but before discussing the 2024 outlook, let's just have a quick recap of what happened in the year 2023. So 2023 was clearly a year of comeback. Comeback in a sense that when we started the year, it was on a bad footing that we started. There was a banking crisis in Europe after maybe 13, 14 years, and uh, and that quickly spiraled to the Europe as well. And then we have our own Adani Hindenburg saga that impacted the market. But after that, when the Fed hinted towards the pause in the rate hike cycle, the market started to factor in the interest rate cuts, and then we have seen some sort of liquidity flowing from fixed income to the equities, and also we have seen the earnings to support the market in a very big way. So it has been a very good year in terms of earnings for the domestic market at least. And towards the year, we have seen some sort of profit booking, and also globally, the geopolitical tension was on the rise, especially related to the Israel and Hamas war. But now, as we entered into the 2024, the market has started to look beyond that, and there has been a stark difference in the macroeconomic environment globally and domestically with India. So globally, we have supply chain worries now that in the Middle East, also the most of the policies that being followed by the government is contractionary still, right? And the growth is a major concern. That's why they are also talking about a cut in the rate, maybe like later part of the year. And again, we have heightened geopolitical tension. So all the major economies, be it Russia, China, US, Middle East, they're all involved in some sort of geopolitical conflict. And the global growth is also going to be, I think, around 2.5, 2.6% this year. So the picture doesn't look rosy for the global market. But on the other hand, if we compare the variables for the Indian market, so the earnings has been pretty buoyant for the domestic market in 2023. We expect the earnings to remain buoyant for 2024 as well. If you look at the twin engine that has been working for India's favor, which is like the manufacturing side of it, the supply side of it, and the demand side of it. So India is maybe one of the few countries globally where both the engines are firing today, and we have a buoyant economy which is able to consume the goods which are produced in the economy, and also we have a very stable government, and we can see a policy continuation for the third term straight as we enter into the election year. So these are all quite positives that we are taking in for 2024, at least for the domestic markets. One of the risk or the worries that lingers on for the Indian market is the rural demand. But we are hopeful that as we enter into the election year, the election spending will revive the domestic rural economy, and we'll see that that segment of the market also participates in the growth. So as we can move to the next slide, as we can see that India has remained the only shining spot in the global landscape, investment landscape, and there is a reason, because if you look at the US, it was last year it was struggling with a high inflation number, right, 8 to 9%, which has over the time gradually subsided to 3%, but is still higher for a developed market. This year the growth is a worry, and IMF has forecasted a 1.9% growth for the GDP growth for the US markets. Global growth is also expected to be benign this year. But on the other hand, if you look at the earnings upgrade that we are seeing in the domestic market, so for the continuous 4 quarters, we have seen the foreign brokerages to upgrade the earnings for the domestic market, and that's a big positive. And as we enter into 24, the earnings expectation remains buoyant. That's the first thing. Secondly, the share of India's GDP growth in the overall GDP growth, right? The world GDP growth is keep on increasing on a year basis. So there are a lot of fund managers who does a basket case of investing for the emerging markets. It means that whatever the share of the GDP in the total GDP of a country would be, the same allocation will be going towards that country, right? So as our share keeps moving from 3% to 3.5%, and maybe in few years it will be 4%, we'll keep on seeing increased foreign flows, right, because of that. And also, if you look at IMF has predicted that from 2024 to 2028, the India's share in the incremental GDP, right, will be around 7 to 10%. So that's a very big positive that if somebody is looking is going to look for growth, right? So India is again one of the major spots which are left, and the money will certainly be chasing the Indian growth story, and maybe in few years time down the line. Now going forward, uh, if you can move to the next slide, please. So this is how the domestic economy is expected to do, and in the past also we have seen the GDP number, especially in the quarter three, surprising on the upside, posting a 7.6% year-on-year growth. And for 2024, again we have a very good outlook for the year. The economy is expected to do around 7.2% growth for the year. The inflation is well under the RBI guideline of 4 to 6%, but slightly on the higher side. And RBI has mandated that they will be doing their best to keep it under 4%. That's why we are seeing the rates, the interest rates again at the elevated level. But the forecast is that as we move into the year, we'll see the inflation rate, the Fed rate and the domestic rates also to come down gradually as the inflation will also subside. The crude prices has been come down, which is again a good for domestic economy. And in terms of GST collection on a year-on-year basis, we are seeing 10 to 12% growth on monthly basis. So that's a good positive, and it's giving a lot of reserve for the government to spend on the government capex side. And that's why we have seen in the last 5 years the total government capex has actually tripled than the previous term. So that's again one of the engine that is working very well for the government. The government capex is only around 25%, but we expect that share to also grow going forward, given that we have a robust GST collection, and also the income tax pool is getting widened, and we have seen record numbers of people filing for the tax returns. So that will give a lot of ammunition to the government to keep on spending on the government capex side. Also, the current account deficit is under control. We have all-time high forex reserve, and the RBI has done a phenomenal job in keeping the dollar versus INR rupee correlation in control. And that's why we expect that the foreign money will don't find it hard to find its way to the Indian market if we keep the growth intact in the domestic market. So now let's just move to the next slide, please. So that's an interesting story how we have performed in the past. So we got independence in 1947, and it took us nearly 60 years to add the first $1 trillion, and the second $1 trillion has come in just 7 years. The third $1 trillion in 5 years. So what we expect that going forward, every 6 to 7 years, the GDP will double, and that will mean that every year we'll be adding in 400 to 500 billion dollars of extra GDP, and that will create a massive opportunities for all the small and mid cap companies out there. In fact, if you look at all the four corners of the country, four parts, the rough GDP number for the four parts is roughly between $0.5 billion to $1.5 billion, and it means that $1.5 trillion, and it means that even a very small player in a corner of the country, it has a wide market to capture, right? So localized plays have a good chance that they can keep on growing at a rate of 20-25% for a decade. As these companies don't need to become the national players, the growth rate in every part of the country is very buoyant, and they can continue to grow it. Let's say, if they are a well-known brand in their own specific region, they can continue to grow at 20-25% for a decade. And we have such opportunities in portfolio as well that we have bought. So we are quite hopeful that as we grow and we'll add 400-500 billion dollars to the GDP every year, the mid and small cap companies will get a good share out of it, and they'll keep growing at the pace that we have seen growing in the past few years. Now, let's move to the next slide, please. So coming to the valuation, so it has been a big worry for the investors that market is at all-time high, and there is a lot of narrative building that valuations are exceeding all-time high levels, or actually going at the long-term averages, going above the long-term averages. So does it make sense to pause the investment for a while and take some money off the table? So if you look at a very interesting analysis which is out there, so in the last 4 years, if you look at the Nifty return, it's hardly around 77%, but the EPS growth in the same time frame is around 118%. It means that the price of Nifty has lagged the EPS growth. And we know that in the long term, the correlation between the price and the earnings is mostly similar, right? So now 4 years is not a longer time frame, but it gives us a cushion that the price is not clearly racing ahead of the earnings and it's well under control. And the growth prospect for the next 2 years is again on the positive side, and we can see the earnings to be compounding at a rate of 12 to 14% for the next 2 years. It means that the Nifty PE, which is currently at around 2021, will be like 19.5 on a 2 year basis. And if we couple that like with a rate cut scenario that's expected to play out, so every 1% rate cut gives say 15 to 17% kind of upside to the terminal value. And it means that the multiple should expand also by 15 to 17% if there will be a rate cut scenario of 1% in the economy. So in the next 2 years, if there will be a 2% rate cut, and that's a very possible scenario to happen. So the Nifty PE, which is looking expensive today, or like looking at all like looking fairly valued at around 20p, will be actually kind of reasonably valued again in 27p also if there will be a 2% rate cut. So it means that the kind of domestic environment that we have, the rate cut scenario, which is also there in the play, the kind of earning support that we are having, it means that the market is kind of favorably valued. And from here on also, we can see like, decent growth happening in the large cap space. Now coming to the mid and small cap space, if we can just move to the next slide, please. Yeah. So the worry is in fact like is there on the mid and small cap side. The index has given a return of 48% for the mid caps, and small cap has grown by around 50% last year. So there is a lot of questions whether we will be able to continue the same growth in the next year, like this 2024 as well. So what we have seen right in the past 6 7 years, that if you look at the free cash flow that a small or mid cap company has generated from 17 to 20, so it was hardly like in the positive side. In fact, it was negative 16%. But post COVID, the company has to become like operationally efficient to do justice with the kind of situation that was there. And in the last 3 years, we have seen the free cash flow generation going up to 51%. It means that the companies are actually having cash on their books, and that cash they can utilize to set up capacities and find out new investment avenues which can supplement the business. In fact, the net debt to equity level, which was earlier used to be 1.4x in FY17, it has come down to 0.2x in FY23. So that's why we have seen that even with a higher interest rate in the last couple of years that we have seen in 2023, very few companies have actually felt the pressure of it. And the interest coverage ratio or the interest outgo that a company has to bear the burden of it, it has actually been very minuscule, and the companies are very comfortable with the current debt levels that they have. And if you look at the kind of revenue growth that we have seen in the past few years, so the revenue growth is clearly outpacing the capex growth. It means that the companies now have like earlier they have performed in terms of revenue, they have the market shares to grow the business. Now they have the free cash flow that they can utilize to again do the capex and continue the business. So in the portfolios that we are running currently, we have seen multiple companies coming up with a capex outlay, and these companies are going to double the capacities over next 4 to 5 years, providing us with new investment, providing us with new growth avenues. So this has been the story of the small and mid caps. The promoter holding is around 70%, which is a very big positive. It shows that the promoters have skin in the game. And the most important part is that the earnings are looking very stable for the small and mid cap companies. And now that we are getting into a rate cut scenario, there will be a liquidity instance as well. So let's just understand how the liquidity will impact the markets going forward. So the last year has been a year in which both the DIS and FIS has come to support the market, and we have seen what it can do to the market, right? So last year, FIS pumped in around $18 billion of investments, $20 billion of investment into the Indian markets, and that has come after a very muted 20 and 21 and 22. So 23 was good in terms of the FI investments, and going forward also, as we see, the dollar is set to weaken. The dollar index is set to weaken as the US Fed will go for the interest rate cuts, and also there will be continuity in the domestic election that we can foresee. So, and the growth will be there. So we can find that the foreign flows will come to the Indian market. Also, India is increasingly becoming a case of a country specific allocation, right? So earlier, like if a investor has to invest in the emerging basket, the share of the India was around 15%, and the majority of share was used to go to China. But now that China has underperformed for a longer period of time, and again the outlook is not that bullish, now a case is coming for an emerging market investment ex China. And there the India weight has gone up from 15% to 22%. That means more allocation will be coming from the FIA side, that will be impacting the domestic market. And the domestic flows has been quite buoyant. In fact, the SIP numbers has been around $2 billion per month, and that's a very big positive for the small and mid cap companies, because majority of the allocation from the FIA side goes to the large caps, but the domestic buying that's happening primarily into the small and mid caps. So in the short term, when the flows will come, they'll expand the multiples, and whatever the number that we are looking today in terms of valuations, we can expect the valuation to grow even further, and the earning support is always there, so we can continue the market to be in upward trajectory going forward. Now just quickly look at some of the key themes that we are bullish about. So the manufacturing is again one of the space which has been a very big beneficiary of all the government push, be it flame scheme, a famous scheme, or like PLI scheme by the government. And then financials are one of the sectors which are expected to do well when a country is as a whole is doing well. And now that we are in a rate cut scenario, so we expect the financial, especially the NBFC side of it, to get the most benefit of the rate cut scenario. And the credit growth in fact for the entire calendar year 2023 was quite buoyant, and we have seen the numbers reaching at a decadal high. So we expect the credit growth number to be again very buoyant for 2024 as well. Building material segment is again one of the sectors we have been quite bullish about for a very long period of time, just because of the fact that the building material segment caters to the infra and to the housing market, and both the segments are very buoyant. In fact, the capital goods segments has uh, has uh, has posted a growth of 20% year on year. The housing market has posted a growth of 24% year on year. So those are the themes that are expected to do well, and we are catering to those themes through the building material segment that we have. So it's a very different way to play the capital goods story and the infra story. But again, it's a very safe way to get into the things and participate that segment. And consumer discretionary, we are quite bullish on. In fact, we are quite bullish on some of the themes like discretionary consumption, especially in the high ticket size segments that we have seen. We have seen the housing demand, especially in the luxury side. Automotive, giving us automotive companies which are in the ticket range of more than 10 lakhs doing extremely well. Then the luxury consumption doing extremely well. So the consumer discretionary companies that we are holding in that segment are mostly oriented towards that, and we expect those companies to do well going forward as well. Now, the key risk to the entire thesis is again first the geopolitical risk that we have, and then the inflation, if it's expected to come back because of the Middle East tension and the rising supply chain cost, that will be a big worry. The rising crude price will be again a concern for us. And then we have a lot of elections slated for this year, starting with India, and then again the US election will be there towards the end of the year. So the election will again be have some pivotal role to play. But we are hopeful that because of the growth, the earnings that we are seeing will be able to surpass that. So now my friend, my colleague Vijay will discuss about some of the investment landscape with all of you. So over to you, Vijay. Now, thank you.
Yeah, thank you, Prabhat, for the detailed discussion on the macro side. Now we will move towards the investment landscape. So in this section, basically, we will try to uncover the winning sectors for the, let's say, for the duration of next 5 to 6 years of period. So what we have done to identify the winning sectors, so basically we did a study of the developed economies. So what we have been tracking in terms of, let's say, US in 1960s or Japan's in 1970s time. So when they were at the GDP per capita mark where India is today, so today India is somewhere around $2,600 GDP per capita mark. So at this when the developed economy was passing through the phase of, let's say, $2,500 to $5,000, $8,000 and $10,000. So which were the sectors which benefited it disproportionately, or which were the sectors which were outperforming? So some of the sectors we were able to identify was like real estate, credit market, retail segment, mobility, electronics goods, durable items, or let's say recreational activities. or the kind of electronic gadgets that people use in term high-end market size. So these were the sectors which were doing extremely well when the developed economies grew from the let's say $2,000 to 2.5K mark to the $10,000 and upward. So why these sectors were outperforming disproportionately? So when we tried to uncover the underlying fact, we came to the simple understanding. So whenever the GDP per capita increases, so it directly increases your personal disposable income at the hand of the consumer or the retailers. And once you have higher income at your disposal, so people will have like their necessities satisfied. Now whatever extra money that they have, they will typically go and spend behind the discretionary items such as the branded apparel, or let's say the branded watches, or the electronic gadgets, or automotive items and leisure activities. So that will lead to the like a huge boom in the discretionary product side. Second thing that we were able to identify was the housing theme. So people tend to prefer the buying house versus, let's say, they prefer to buy a house versus renting a house because of the higher income that they are generating. And that leads to the boom in the real estate market or the housing market. And that also pushes the, let's say, the revenue and profit of the manufacturing companies which are making the, let's say, the building material products such as the PVC pipes or the steel pipes, or wires and cables company, or such as the paints company or the laminates company. So all these building material companies who are manufacturing domestically will gets disproportionate benefit of the housing boom that is happening. And these two themes, first is the consumer discretionary and second is the housing theme. So to fuel this rally, typically the capital is required, and people tend to borrow the capital from the NBFCs and banks for this purpose, because now people have become comfortable with the earnings that they are, let's say, the income they are generating, and they have a certainty of the income that going up with the GDP going up. So they feel much more comfortable like borrowing against the future income that they will get in the let's say next 5 to 10 years, and they borrow this. The consumer credit also goes up, and the consumer credit boom also happens. So these are the three segments or the three themes like we found out that these were clearly outperforming the other sectors: consumer discretionary, manufacturing of the building material products, and third was the consumer credit. Now we move to the next segment where we'll try to crystallize the numbers for the Indian economy. So in our humble estimate that we are trying to project from the current scenario to FY32 approximately. So what in our conservative model that we are forecasting our Indian economy should be at least around $8 trillion mark, which will come around $8,000 billion. And if you look at the retail number, so the retail market somewhere around is $781 billion today, which is a 41% of the consumption share, which India is around $1.8 trillion market. And it will grow at 9% CAGR, 8.9% CAGR precisely, to somewhere around $1.84 billion by FY32. But if we look at the change that is expected to happen in terms of grocery retail and the non-grocery retail, which is a discretionary market. So discretionary market is expected to grow around 12%. So which is a 3% higher versus the total retail market, which will grow at around 9%. And it will be nearly double, or let's say 1.9x of the grocery retail market, which is the necessity items of the consumer goods that people consume on the daily basis. It will grow from $500 billion to almost $9.4 billion. So that is how like the consumer discretionary market will boom disproportionately versus the grocery retail market, or let's say the necessity market. So these are the three winning segments of the sector that we have identified. Now, naturally, the question comes to mind like, let's say, how can you pick the businesses which will, let's say, the winners in terms of the, let's say, if you look at the 5 years or 10 years kind of duration. So we will use the internally built model, or let's say the framework that we have developed at RH in the last 6 years that we have spent and mastered that framework. So we will quickly discuss it. So our framework revolves around the two legs. First is the growth and second is the value. Of course, the regular attendees of our webinar series might have been familiar with the framework that we have discussed over the last webinars. But just to benefit of the newer audience and the large people, so we'll just quickly revisit the framework and move on. So the first part is the growth. So typically we will look for a business which can double the earnings in the next 4 to 5 years space and it should be higher than the industry growth. So let's say the industry is growing at a 12%. So we look for a business which can grow up to 18 to 20%, and it will double its earning in the next 4 to 5 years period of time. Second part is the valuation. So typically we will buy a business, or the interest will generate in the business when the business is trading at a substantial discount to the industry P. So let's say if the industry as a whole is trading around 45 P, so we look for a company which is trading at a discount of, let's say, 30 to 40%. It may be trading at a 25x P or the 30x P, and it should be also at a discount of the leader. So let's say if we take example of paint segment, so leader is the Asian Paint, which trades around 80x P. The whole sector trades around 50 to 55x P depending on the price, and the emerging leader that we will typically be interested in should be trading around, let's say, 30 or 35x P. So that is how we try to get the margin of safety from the valuation point of view. So let's say if the valuation goes up in the same duration, let's say the valuation is 30x when we have entered, and it reaches up to the 60x P, which is the industry P. So we'll also get the double, like the 2x upside from the valuation side. The profit will also grow up in the 4 to 5 year. So if we multiply the 2 into 2, so the business can generate at least 4x kind of return in the whole investment journey. So typically, we identify around 25 to 30 businesses from the different segments to diversify the any company specific risk, and we expect at least 3x to 4x upside from the each businesses. Of course, sometimes the thesis don't play out of as per our conviction. Typically, we have seen the ratio is around 15 to 20%. So the diversified portfolio helps us to get at least 3x or the 3.5 kind of like the upside that we can internally project on. So that is how our the multi-bagger framework works like. But this is only the written part of the framework. We have also the integral part of the investment framework is our risk management philosophy. So our risk management philosophy has three legs. First is the business risk, second is the valuation risk, and third is the corporate governance risk. So typically, when it comes to the understanding of business, so we will typically go for the businesses which have a strong moats, which are visible in terms of their capital efficiency over the long period of time. So we don't believe in qualitative moats only. So qualitative moats can like people can have different type of qualitative moats. They can list n number of qualitative moats, but they are not visible into the capital efficiency. So those are meaningless moats. Okay, that is just a perception of the moat, but it's not visible into the financial statement. We look for the businesses which will have strong moats. Of course, we will also not entertain any businesses which are having like cyclical earnings, or the predictability is not there in terms of the earnings. And we will also not go for the company which are having very thin moats, or the narrow competitive advantages, because the capital efficiency will keep degrading in the long period of time. So that is how we mitigate the business risk. Second is the valuation risk. As we have discussed, like as per our philosophy, we typically don't buy any businesses which are trading at a overvalued zone, or let's say it's not fairly valued. So we'll go for the business which is trading at a safe margin, or let's say the discount to the industry P or the industry E by beta or whatever metric that industry is tracking, and that will get us the margin of safety. So that is the second part of the framework, and the last is the corporate governance risk. So we keep meeting a lot of promoters on the day-to-day basis, and typically we don't let's say don't align with the promoters' interest where they are misallocating the capital in terms of the increment capital allocation, because it destroys the capital efficiency or the return on capital employed, which also destroys the incremental returns that the company generates. Also, we don't like the promoters which don't treat the minority investors friendly, or they are not transparent in terms of accepting those mistakes. So these three legs help us to avoid some pitfalls which can come from the, let's say, picking the wrong kind of business, or the low margin business, or the low mode business. So that is how the risk and return comes walks hands in hand when we are doing any investment. So we'll use just a single case study to understand how this the framework that we have discussed in theory applies in the real time. So one of the business that we have entered somewhere around October 2020 was the APL Apollo Tubes. So it is the leader in the structural steel tube space. So we entered around 33xp, as it's visible in the bottom part of the table. Like entry P was somewhere around 33. Recent P was around 55p. The earnings had almost gone up 3 times in the 3 years, and the multiple that we were discussing, the valuation part, has gone up of almost 1.7 times. So if we multiply the 3x into the 1.7 times, so we got around 5x return in this investment that we carried out somewhere around October 22, around 3.5 years of period that we have currently now. And the volume has grown up similar into the line, and also the earnings had gone up. But what happened in the recent time was, like, if you look at the numbers on the left side where we have talked about the APL Apollo Tubes sales volume. So if you look at the numbers from Q2 FY23, the volume has been stagnating around 6 lakh ton. So which is the left axis where we are mentioning that 600,000 ton, which is around 6 lakh ton for the quarterly volume that they were selling. And what we have observed, like the company has been stagnating to, let's say, grow their volume beyond the 6.5 lakh K 6.5 lakh ton mark, and it has been in the last 6 quarters failed to get any meaningful upside on the incremental upside side. So that is only the quantitative part. We went one step below and we tried to understand what was happening. So we came to understand, we came to the rationale that the company which had done the recent capacity expansion and the high-end manufacturing product that they were manufacturing. So it was not, let's say, the ramping up as per the company's expectation, and the growth that they were assuming is not percolating or not happening on the ground level side, and which has led to the, let's say, the flat volume growth, or in kind of, let's say, the growth momentum going down substantially, which was one time in the last 2 3 years the volume was going up 25 to 20% on the each quarter side. But now the volume has almost come down to the, let's say, the 15% mark in the last quarter, and this quarter when the company has published the quarterly update, it was almost 0%. In fact, it was actually the degrowth for a particular company. It's a fantastic business. It had done the fantastic compounding for us. It has generated almost 5x return for us. But typically, the business risk has come from a risk management framework because the incremental product sale is not happening. Secondly, the valuation has also gone up from the 33x P to 55x P. So for us, the valuation again becomes challenging because we typically don't buy a company which is overvalued. So we simultaneously we started to look for some emerging leader in the same space, and we found out one promoter who had recently done the capital raising in 1 year before, and he has been growing and deploying the capital very efficiently, ideally in a way we would like. And it has posted fantastic number for this quarter as well. The volume went up almost 76%. Also, the quarter on quarter growth, typically we don't track those numbers, but it was also healthy 24% because of the seasonality reasons. So we had the clear substitute for replacing the existing leader, and we exited this APL Apollo tubes, and we moved on to the emerging leader in the same space of the steel tubes, which is trading around 30xp, and we typically envision that this 30xp should again go up to 55 or 60 times in the next 4 to 5 years, and we can expect the earnings to go up at least 2 to 2.5 in the same period. So that is how the whole framework revolves around. So nothing like APL Apollo is still a fantastic company. Just a stock disclosure. So this is only for the education purpose. People can take their own view and own analysis before buying or selling a particular business. And the emerging leader that we have picked by replacing the APL Apollo tube. So we expect it to at least double the earnings in the same next to 4 5 years of period of time. So that is how the whole risk and return framework that we have discussed works in the practical manner, and it also helps to redeploy the capital, or let's say the redeploy the profit that we have gained from the, let's say, the APL Apollo tubes or any the investment thesis of the past bull cycle. So now moving on to the themes like that we are bullish on the next from the 5 year perspective. So we all know the last bear market started somewhere around January 2022, and it lasted till the March 2023 end, FY23 financial year end. So in this 13 to 14 months of sweet scenario, we met around close to 90 promoters physically and also on the online side. And we picked the different businesses. The themes were, of course, coming from the three sectors that we are bullish on, like the consumer discretionary, manufacturing of the building material products, and third was the consumer credit. To just give an example of one of the company that we hold in the wires and cable segment. So it's a trading at a 43x P, discount of around 17% versus the sector leader, and the earnings are expected to grow up at least 2 to 2.5 times in the next 4 years period of time. So similar, if we multiply the 2x number with the 1.5x kind of upside in the valuation, so we get the 3x kind of return from that particular thesis. Similarly, the consumer credit company, which is coming from the NBFC space side, is trading around 2.7 times it's the book value. and the sector itself is trading around 5x. So discount is around 50% for this company. So the multiple can go up easily 2x, and the earnings can, we are expecting around grow by 2x. So if we multiply the 2 into 2 number, so it will like come to around 4x kind of things. So this is how the we have picked our portfolios, different themes, around 25 to 30 different themes across diversified things, and we expect it to do like 20% kind of earnings growth at a portfolio level from the next 4 to 5 years perspective of time. And all these efforts that we have put in last 4 to 5 years of time, and the last previous bull market and the bear market, so it has also resulted into the strong performance for the strategy that we have been managing for almost 4 years of time. So the performance can be also the output or the result of the, let's say, the litmus test for the portfolio processes that we have been creating. So we can move to the next slide, please. Yeah. So this is just a output or the litmus test that whatever we have been discussing and talking about the thesis or how the our framework works around. So if you look at the numbers, like the since the current fund management takeover, the portfolio has been compounded on 41% CAGR, while the index has compounded around 23% CAGR. And if you look at the little bit of a simplified manner, so 1 crore invested in last 3.25 years has become almost 2.9 crore, and the similarly, the index has also compounded a healthy space of 1.9 crore. So this is how we have been able to reward our investors, and we are humble enough to that they have put the trust in our let's say investment framework and the investment philosophy they have been we have been talking and vocal about for the last 4 5 years period of time. So in a nutshell, if we conclude, so we strongly believe in the India growth story, and we think that this is not a 1 year or 2 year trend. It's a multi-decadal journey of wealth creation. Of course, it will have its ups and downs, but if we pick the right businesses or the strong businesses, we can get the handsome rewards. In our humble opinion, we think that mid cap and small cap space is better suited to play this whole journey. And if anyone wants to be part of this journey with us, so please feel free to get in touch with us. And with this, we will conclude this session. And thank you, ladies and gentlemen, for listening us patiently on this Saturday morning session. And thank you, everyone, once again. And over to you, Archana. Yeah.
Thank you very much. We will now begin the question and answer session. So the first question is, Realty has been amongst the best performers in 2023. Are we holding any realty stocks in the portfolio?
Yes, right. So, realty has been the best performing sector, and just like what Vijay was highlighting, that we have a clear framework for selecting the stocks in the portfolio. So, we don't go and buy. In case, in past, if you look at the realty stocks, so they have their own issues, right? The capital allocation was a big problem for the realty companies. That's why we have not bought any realty company directly, right? But we have played it through some of the auxiliary names, right? So, for example, we are in the portfolio where we are holding a lot of building material companies which are supplying to this real estate players, right? For example, we are holding Circa Paints in the portfolio, we are holding Apollo Pipes in the portfolio. Then we are APL Apollo Tubes was a part of the portfolio till very recently that we have substituted to JTL Industries, and so these are all the plays which are indirectly linked to the real estate cycle and the infra cycle, and we are more comfortable playing this real estate and infra cycle through those names, as we have more comfortable comfort around the capital allocation policy, and also we find these companies to be very reasonably valued. And since there is the shift in the cycle, for example, real estate cycle is a 3 year old cycle now, and maybe for next 3 4 years it will continue to perform. But the companies that we are holding, so these companies have the longevity to continue to perform for, let's say, next 7 8 9 10 years, right? For example, KEI is one of the companies which is again is a building material company in the portfolio, and we have recently made a 10x gain in that company, right? So we are trying to find out the same story but try to play it through a different names, so that the risk is diversified across different companies. For example, let's say one of the real estate players which is coming up with a project and has done phenomenally well in the last 2 3 years, but for some reason the projects get stalled, so the earnings and the stock price will take a beating in the subsequent quarters. But let's say a company like KI which is supplying to different players in the market, so even if, let's say, one player is not performing well, the risk is diversified across multiple names, so the companies continue to find new avenues for growth. And that's why we are more comfortable playing it through the building material side. Yeah.
Thank you.
Rachana, hopefully that answers the question.
Yes, thank you. The next question is, when can we expect rate cuts for Indian markets? Will the market rally before or after the rate cuts?
So on rate cut side, the street is expecting at least 5 to 6 or 1.5% rate cut in the US market for this year. And similarly, for the Indian market as well, we are expecting at least two rate cuts this year, which means around 1% of the rate cut that we'll be seeing. So market typically rallies in anticipation of the rate cut, right? So last year also, when we have seen the multiples to expand, in the short term, multiple expands on the anticipation of the flows, and as the flows becomes part of the market. So we have seen the market rally from March to June or July, because there was anticipation that towards the end of the year the rate will cut, right? So similarly, in anticipation, the market rallies, and when the event actually happens, right? So then the earnings has to come in on the lower interest rate to support the market. So if the rate cut has to happen in, let's say, in third quarter or second quarter, so the rally will be seeing in the first 4 or 5 months only. And towards the end of the year, we might see some sort of profit booking, and after that, the earnings has to come in and support the market from those levels and to take it to the new all-time high levels. So this is what the view is. Yeah.
Thank you. The next question is, markets are at all-time high. Should we wait for doing top-ups?
Yeah, so we have
Yeah, Vijay.
yeah. So as we have discussed in the first section of the session as well, like the Nifty P, or if we look at the small cap P, so the various valuation matrices, so they are still in the zone of fairly valued in terms of, let's say, the valuation side. And if we talk about our own portfolio, so we don't have any, let's say, the companies which are overvalued zone. So we keep rotating the companies which are overvalued, or let's say the investment thesis has already completed, like we mentioned in one of the steel tip company, the investment thesis was almost complete, and the valuation has also catched up at what we had expected in the next 4 or 5 years. But it happened in the 3 years, so because company did extremely well, and we moved on to the next emerging leader, which was from the steel tube segment. It was available at a reasonable P. So the portfolio level, we don't find any challenges. Of course, the, let's say, some geopolitical tension, or let's say some unforeseen scenario, or some kind of black swan event, market can correct, let's say, 10, 15 or 20% as well. But the long-term growth rate, or let's say the longevity of the growth rate, remains still the 20% for our portfolio. Of course, there can be, let's say, 1 2 year of stalling, but that will be the good time to again top up. But we don't see any material challenge in terms of the, let's say, the earnings growth or the valuation peaking out, because in isolation, the stock, or let's say the all-time high index level, doesn't tell anything. Let's say we were 18,600 even in the September, somewhere in October 20, but the P was substantially high when we were at October 20, 18,1600. But today, if we look at the even the 21.5K mark, so the valuation is around 20x P for the Nifty, because earnings have come up, and even the earnings graph that we have captured, so it's still at a substantial, there is a still substantial gap between the EPS and also the indices prices. So we don't see any material challenges. So the people who have a long-term vision, of course, the 4 to 5 year kind of at least investment horizon, they can look to put money in the strong businesses or the strong portfolios, and they can have a view of at least holding till at least 5 year plus kind of view. So we don't see any challenges. Of course, the people who have a shorter duration of, let's say, investment horizon 1 year or 2 year, so typically we won't advise for the kind of portfolios that we manage. So ideally, the investment horizon should be at least 4 to 5 year plus one only. Yeah. So that is how we will advise. I hope that clarifies the query. Yeah.
Yes, sir. Thank you. And the next question is, how many stocks are being on hold in RH Super Value, and what is the weightage of large, mid, and small caps in percentage terms?
So if we talk about the, let's say, the broad number, so it keeps changing based upon the different prices and the entry and exit we do on the quarterly rebalancing side. So we typically own around 25 to 26 different businesses from the portfolio. So typical size always is between 25 to 30. And if you look at, so right now we are more bullish on the small cap space versus the mid cap space because of the cheap valuation that we are getting from the emerging space side. And we also hold 2 to 3 different names from the small SME side, which are on the SME platform. And the promoter has been very much competent, and they have been shaping up the business as per our expectation. So typically you'll find around 40 to 45% of the mid cap and balance from the small cap side. And around we hold typically around 5% cash. Of course, the exact number we can always share with you through our fact sheet and internal data. So that is how our portfolio composition looks like. So little bit tilted towards the small cap side as of now. Yeah.
Thank you. The last question is, many mutual funds have stopped taking flows in small and mid cap names. Clearly, they are bearish on small and mid caps. Are we able to find invertible ideas even with such run up in 2023?
Yeah. So the reason why these small and mid cap mutual funds have stopped taking inflows is that they have a size which is larger, right? Around 3,000 crore or to 4,000 crore that they have to manage, and that's the reason why the investable ideas that they have to look for. So it will only be coming from, let's say, the NSE 150 mid cap index or maybe small cap 250 index, right? But if you look at the size of super value, it's around 140 CR, right? So we have the opportunity and we have the flexibility to go a level deeper and in fact find out the companies which have a market cap of 600 CR to 1000 CR but are doing phenomenally well, and these are the overlooked segments. And it means that the ownership of these companies by institutions is very less, and majority of the stake is owned by the promoters. And there we have the flexibility to go and buy those names and in fact hold in the portfolio. So that's why we are not stopping the flows in the super value portfolio, and we continue to find out new ideas, and as and when we feel that some of the ideas in the portfolio are maturing, then we have a ready list of 7 to 8 stocks which are from the same framework of doubling the earnings and doubling the multiple expectation, right? So we continue to switch those ideas in the portfolio and taking out the winners from the portfolio. So that's why we keep rotating the ideas and we keep finding out new ideas to include in the portfolio. Yeah.